Hey, welcome to Investing with Stef. Today we're going to talk about the stock market terms. This is going to be part 2. If you haven't watched part 1, I highly recommend go do that. I'll put a link up here somewhere, and I'll also put a link in the description below. I highly recommend watching part 1 as that covered more of the basics. This one is going to go in a little bit more depth on different terms and terminologies. Hi. My name is Stefan. If you're new to this channel, we talk all about investing, and we also give you all the information to be a better investor, or maybe just to start investing. If you've ever heard about the term financial education, this is what it is. Watching videos, reading books, listening to other people, and this is what Bill Ackman said. He said investing is really a great thing to go into as you can educate yourself. So well done on you. If you're watching this video, you're already one step ahead of thousands, millions of people around the world, and you are on the way to be financially independent, and also just to maybe look after your kid, or just to have a better life in the future. So let's jump right into it. So today we're going to talk about 10 terms very quickly, and we're not going to go into too much detail. First, we're going to talk about a dividend. What is a dividend? If you've ever heard of dividends, dividends you can get from different types of investments, but it's basically just a company have some earnings and they want to distribute that to their shareholders, and they do that via dividends. So when they distribute it to shareholders, that means that they share it with their people that's owning their stock. So where can you find a company's dividend? Let me just show you quickly. You can go on Yahoo Finance, just go to summary. You just go down. I always use Coca-Cola because everybody is familiar with Coca-Cola and it's a very famous company. So you just go down and you'll see here it says forward dividend means 168. That means $1.68 every year you will get from Coca-Cola from having one share. Now, obviously, if you have 100 shares, you're going to get $168 a year. The yield means it's 3.16% of this stock price that they will pay out in dividend. We're going to cover yield a little bit later. The next one we'll cover is capital gain. If you ever heard about capital gain, that means the amount that you get from after you selling the share or selling that investment. So if you have a house, you bought it for 200,000, you sell it for 250,000, you will have 50,000 capital gains. So it's very easy to understand. You can get that from all types of investment. The next one is a bond. A bond is simply debt. So a company will go out and they will issue a bond and ask for somebody to loan them money, and you will also get a yield on your bond. So a bond is just, you can get a corporate bond, you can get a junk bond, you can get a treasury bond that's through the government. A junk bond is simply a company that's not doing so well and they're asking for debt, and if you buy their bond, you are likely to default on that bond, or you might get a higher yield, like 10% or 20% yield on that investment. So I'm talking the whole time about yield, but what is yield? Yield is simply just the percentage that you get on your investment, the gain that you get on your investment. So let's make an example. If you give $100, 100 rand, 100 rupees, whatever currency you are, if you give 100 to the government and you have a 2% yield, that means that at the end of the year, or let's say it was 1 year loan that you give to the government, at the end of that year you're going to get $102 if it was a 2% yield. So simply it's just a percentage of the gains that you're going to get from your investment. The next one is a basis point. A lot of terms they use in investing is basis point. Just remember that in a lot of people don't invest because they feel like it's this elephant to understand. You know, it's very difficult to grasp the concepts. Yes, of course, it is a different language. Yes, you have to study it because it's almost like learning a new language. But once you have it, it's easy, and that's why I'm making these videos, to try to help as many people as we can. So a basis point is, it's simply 1/100th of 1% or 0.01. So one basis point is 0.01. Here you can see 100 basis point is 1%. So they just break it down like that for to go in smaller denominators. Excuse me. So if you've learned something so far from this video, consider subscribing, at least like the video. That will help with algorithms. We are on a verge or on a mission to reach 10,000 subscribers by the end of this year, to try to get this to as many people as we can. So join the journey, and let's try to educate as many people as we can. Next is volatility and volume. Now, all these terms, I put them together because they were interesting to me. It's not to say that it's all the stock market terms, but at least it will give you a step forward. Let me put it like that. So volatility and volume, a lot of people confuse the two. What is volatility? Volatility means the price movement during a specific time period. Look here. At 1180 this stock was at this day, and it ended at 1380, so it moved by $2. That means that the volatility was high because it moved by 2. If the volatility was low, it would have only moved a little bit. You see here the volatility was low, so this stock is a highly volatile stock. It was a BlackBerry. The volume means the amount of shares that was traded that day. So if here you can see on that day there were 250 million shares traded on that day, and some days were only 50 million. So it was a high volume day and low volume for that day. That is the difference between the two. See, not so difficult to understand. Number 7 is stop loss order. Not everybody uses stop loss order. Mostly day traders, mostly traders, or mostly people that feel like they don't want to lose too much on their investment. So how does that work? You buy the stock at 100, it moves up to 120, no problem, you don't want to sell. Let's say you don't want to look at your computer. You put it into the computer. You tell the algorithm in the computer, listen, if the stock reaches a certain amount, I want you to go ahead and sell it. I don't even want to worry about it, because if it moves under a certain price, I think it's going to keep going down, and I want to cut my losses. I want to protect myself from losing too much money. So you just tell the algorithm a stop loss order so it doesn't move too much. You probably won't use it right now, because if you're watching this video, you are just learning about investing, so don't worry too much about it. I just wanted to introduce it to you. The second one is the securities. Security is not a guy that's standing at your gate protecting people from coming in or at your door. A securities in the investment field means a financial instrument, something that you can invest in. So I invested in a bond, and that is a security. I invested in a stock, that means it's a security. You can see the different types of securities that you get in the investment field. The next one is options. Options, also known as derivatives. And yes, just so you know what an option is, it is a contract that gives the buyer the right to buy or sell an amount of product, normally 100 shares, of an underlying security. Just bear with me here. It's a little bit detailed, but we're just going to cut the surface here. During a specific period of time, called the expiration date, and at a predetermined price, called a strike price. So if this is the first time you ever heard of options, let me explain to you how a call option works. You have the right to buy something from somebody, right? But you have to pay them for that. Let me give you an example. You have a bicycle. I want to buy the bicycle from you. You want to sell the bicycle. But I don't know if I want to buy the bicycle now or later. To secure that, I'll say, okay, I will give you $5 to hold on to the bicycle for 30 days. So I will give you a contract to say I will buy this product from you in a 30 days, expiration date, specific time, for 30 days. Just hold it for me, I'll give you $5. Okay? You want to sell it for 100. I give you $5 to hold it for me. So the price that you want to pay, that you want to sell it for, is 100. Now, let's say in that 30 days, I come back after the 30 days, I say, okay, I will buy the bike from you. Then I have to give you the $100. right? Now you made $100 for your bike plus the $5 I gave you to keep it for me, right? So I have 30 days to decide if I want to buy it or not. I hope you got me here. So options are pretty detailed, but it's very simple to understand after you understand the concept. If I don't buy the bike from you after 30 days, you get to keep the bike and you get to keep the $5 I gave you. So you actually made $5 just by holding onto the bike, not trying to find another buyer. Maybe I can go out there, get another buyer that wants a bike for 200. I come to you and I say, okay, here's your 100 plus the 5 I gave you to keep it, and I take the bike and I turn around and I sell it for 200, so I made 95 bucks. I hope you understand that. Listen to this video maybe once more so you can see what option. Go look at other people's videos on options. The last one that we going to talk about is margin. Margin is simply using a little bit of your money and using a brokerage account's money or a bank's money. It's basically a debt. So you say you put 2 coins and you use margin, other people's money. Now the problem with margin is if the stock goes up, you make a lot because you use their debt plus your little bit of money, and you can sell it and you make quite a lot. You give back the margin. Good. But if the stock goes down, you will get a margin call and you will have to cough up your, obviously not your because you put it up, but the money that you loan from the brokerage account. So margin is definitely a no-go. Don't trade a margin, of course not. But if you know what you're doing, you can obviously go and do margin. But if you're watching this video, no, don't do it. But margin is purchase of securities with money borrowed from a bank or brokerage account. So there you have it. Consider subscribing. Please leave down a comment down below if I haven't covered something that you think it's important in the investing space. Maybe you want to have me cover something. Leave a comment down below and let me know what I can talk about. Maybe I should make a video for you on something that you want me to make a video from. And remember that we are trying to reach 10,000 subscribers by the end of this year. So please go ahead and discussion. I will surely write to you back, and I'll see you in the next video where we will talk about some more investments. See you in the next video. Have a good day. Bye bye.